Walt Disney is one of the unique and giant corporations in the entertainment industry. They have theme parks in the United States and other locations worldwide like Paris and Hong Kong. They own a number of US and international TV channels like ESPN, FX, and National Geographic. And in my opinion, having many sub-businesses actually is becoming a problem for Disney when I looked at the financial statements, because their capital expenditures are very high and preventing the corporation from creating great value for the shareholders. The capital expenditures is how much a company needs to spend just to maintain their assets and keep them up and running. As a value investor, creating value for shareholders is very important when analyzing any company. Disney has one type of equity security, and the ticker symbol is DIS, and the current stock price is $90. The revenue graph tells us that they are doing very well with their customers, and the small decrease in 2020 and 2021 is probably due to COVID shutdown, and we're not expecting this to happen again. Their free cash flow graph, on the other hand, tells us a different story. Generally, it is down since 2018, and the company is struggling to provide value for the shareholders. The debt-to-asset ratio is 24%, which is an acceptable ratio, but their ability to service the debt is decreasing, which is, in my opinion, a very concerning observation. And from my experience, the market is very sensitive about this issue these days due to the increase in the interest rate. Disney is not buying back their shares, and they are issuing a very little number of shares every year that, in my opinion, we don't have to worry about. Unfortunately for the investors who like dividends, since COVID, Disney decided to stop distributing dividends, so its dividend yield is zero. To forecast 2023 revenue, in my opinion, we should use the total assets to revenue ratio, because their assets are what makes them very unique. This will give us around $85.5 billion in revenue. The free cash flow to revenue ratio is also in decline for the past few years. Last year, Disney only was able to convert 1.3% of the revenue to free cash flow. But in my opinion, we should expect more for this ratio in 2023, because we have the second quarter report and it shows more free cash flow compared to the first 6 months of 2022. So I'm assuming it will be around 2.3% or $2.2 billion in total free cash flow. Dividing the $2.2 billion free cash flow over 1.8 billion outstanding shares, discounting it by 2.5% since we are halfway through the year already, and using 5% return on investment ratio, in my opinion, the intrinsic value of the stock is $23.73, which means that the stock is so much overvalued. If you accept 1.3% return on investment, which is very low, then the intrinsic value is almost the same as the market value. This valuation made me kinda disappointed with Disney's financial performance, because I really wanted to own this stock and hold it for some time. But I think I will wait until they find a way to increase the value they are creating for the shareholders. And finally, please consider subscribing to the channel to motivate me to make more videos.